Well, hello everybody. Happy summer from Ken Winans and Stephanie Larson at Winans Investments. And it's been nearly a month since the success of our Winans Investment Conference. And we want to thank those of you who made the effort to come out to it. And I know, unfortunately, not all of you could have come for a lot of different reasons, but by any measure, we view it as a very positive success. With the exception of one thing, our audio visual did not work out well. No surprise there for any of you who know me in technology. It always seems to malfunction at conferences with me. So what Stephanie and I thought we could do today, briefly go over some of the points that we hit on, because I know many of you have asked for the raw footage. Folks, I don't want to waste your weekend on some stuff you can hear it okay, but we were shot at a very long distance. So let's us just go through the key things, and then certainly call us if you want to go over any of these things specifically. Some of this is not going to be new to you because I was literally just hitting on the points that we brought up over and over and over again on so many of our videos. The first thing, I know that there's a lot of excitement in the air that inflation is now running at only where it was in 2021. Folks, it is still 2.5 times higher than the Federal Reserve's target. So it is still a problem. It's not as bad as it was, but I would also just say that inflation typically pulsates. It doesn't go straight up. It doesn't go straight down. History supports that. But the bigger thing that Steph and I hit on was global stagflation, which means there is some growth, but after you factor in inflation, there really is no net real growth. And so it's a bit of a game of getting excited because certainly some sectors of the stock market have bounced back this year. But again, if you look at it over 18 months, we're still nowhere near the highs of the very beginning of 2022.
I think though that the Fed has already announced that they probably, air quotes, are going to do 2 more rates. I think they're just trying to prime the market for it. I think they will. I think it's a little premature personally. I would have said, hey, there's a possibility, but let's wait and actually see. The thing is that I think that will actually push rates down probably closer to 3% by the end of the year, depending on how high of a hike they do. The labor market's going to be a big factor to this. It affects the consumption model and everything like that. But with that rate level, if we can really get inflation back down there, people are going to really start to clamor for how to stop. And I actually could see a meaningful pause next year, possibly even a rate cut at some point if inflation continues to drop. So there's a lot of factors at play here. The one benefit is that by them slowing and the events of this year, our fixed income side has improved quite a bit. So while there has been stagflation and inflation is lowering and all that, it is actually a kind of a living organism right now. It's something that changes day to day. So we're just going to keep watching it. And while we see the stagflation, I'm personally not as concerned. I really worry about the bond space. So that's kind of what I'm keeping my eye on. But it'll be interesting to see what the Fed does because they're hinting at it, which means they probably will. But it would be interesting to see if it's really short-termed or are these rates going to be held for longer periods? That debate is the thing that I'm actually hearing a lot in the industry right now. What happens if the rates stay for a long time? I think the numbers are going to be what pushes it one way or the other. So we'll see.
Also keep in mind, the U.S. is not in a vacuum. The European Union is still raising interest rates. The news came out of China yesterday that their manufacturing sector is slowing down. News came out that our manufacturing sector is also having some things. Again, I think the white elephant in the room is the cost of borrowing. When it costs more money to get things done, you have to raise your prices. And when you raise your prices, there's fewer buyers, especially in an economy where things are iffy. So there's just, again, this is what we call the normalization of the interest rate landscape. We all knew this was coming. It was long overdue and happening, but it's going to be affecting many areas differently than others. We did talk a lot, by the way, just general things about stocks, bonds, real estate, commodities, briefly on the foreign markets. Our panelists, who were experts in various fields, especially real estate, spent a lot of time talking about that. The other area that Stephanie and I tried to spend some time on, and this is just more of an observation of as we talk to clients, talk to other investment advisors, talk to the custodians. Our custodian from Schwab was here, and we'll briefly talk about that in a moment. But it's this psychology issue that I still see wearing on all of us. I sense there's still a sense of impatience and anger with a lot of people. I think it's still part of that post-COVID trying to get our lives back to what we would call normal. And the truth is that that's still hard for many people to get to. The other thing that we've just noticed, I would call it tight money stress. I mean, we joked a lot about it at the conference about back in the late 70s when people were getting mortgage rates at 18%. What was lost on us today we would say, what was wrong with you? Back then, they were happy to get a mortgage because they couldn't qualify. I think that for the first time, there's a lot of people who are having to deal with tight money, and they're getting told no a lot more. They're being told no on auto loans and mortgages and business loans and all kinds of stuff. They're just being told no. So that's putting stress on people. The other big thing, I know we've talked about this many times, it's just the general misuse of technology. I listen in on a lot of the phone calls that come into this office that go to Amy and Mindy and certainly Steph and Brittany. And a lot of the comments are that people pull out their iPhone on a day when the market's been volatile, and this might be a portfolio full of bonds, and people are getting upset when they're looking at a snapshot valuation that's probably not even really accurate. Again, the technology of that iPhone was geared towards stocks, not bonds. And so I always bring up, using it to look at your bond portfolio is a bit to me like using Zillow to analyze your house on a daily basis. They're just not well suited. And then last but not least on the psychology thing, there's a generation of investors, and they're actually in Stephanie's camp. You know, for this entire century, there was just nothing like this. You have to go back to the late 70s and early 80s to find an inflation cycle like we have. So it's a lack of experience, a practical experience for people, adults, on even handling this thing. And so we just try to remind everybody, it's not wrong to feel scared. It's not wrong to be frustrated with things. Hey, we are too. But that is the world we're in today, and the world is not going to go back to the world we knew in that Goldilocks zone anytime in the remainder of my career.
I think the fear is the one that I'm personally hearing the most of. At least a half a dozen phone calls a week. Fear. It was fear of the banks. Is my money safe? Should I pull it out? Then it was the tight lending issues. I can't get more money. What happens if I have liquidity issues? Some were fear of their portfolio. Should I liquidate everything? Answer is no. In general, I'm going to always say no. I mean, situationally specific, but the fear gauge, I believe, for people is at a very all-time high, and it's not because of the instance of something specific that's happening right now. It's the prolongedness. You know, if you look at what happened during COVID, you know, you had kind of the flash crash of March, and then everything just took off for the rest of the year. And if you read my commentaries that I wrote in 2020, I kept saying how this was ridiculous. There's no reason for it to just take off like this. Well, then what happened? Well, then we had two tougher years, especially last year. You know, especially once the Fed really started to manipulate the market. I mean, by its actions. What I mean is it made its decisions and then the market reacted to it. They weren't manipulating the market. But, you know, the point is that it's been a year and a half plus. If you really go back to 2020, because during that time was very scary. No one knew what was happening. Then you go through COVID. Then you had supply chain issues. Then you have inflation. Now you have interest rate changes. Then you had the financial, credit tightness. But the financial crisis with a few of the banks going down. So I think it's just been a prolonged 3+ years of just ongoing fear or imminent fear, and people, they're not seeing their portfolios go up 8% every year like they were, and they just don't know what to do. And so they're borderline panic. And then you overlay that with maybe some political fears on either side. And it's a cauldron of a lot that I think clients are just, internalizing. So I feel allowing us to be the cool minds if there's something really concerning in a portfolio, we're going to address it. If something that's going to personally affect you, you will hear from us. And if you're not, it's, don't let the media, because I really lay this at the feet of media, to be honest. They get paid to scare you. They get paid to be the thing that you have on all the time. If it bleeds, let it lead. I mean, that's been the saying for decades, right? So take everything with a grain of salt. Make sure what you're listening to is balanced, or maybe don't listen to as much of it. And if you have a genuine concern, ask us about it. And really, you got to take a step back and have, patience when it comes to your portfolio, and a little bit of common sense and patience and compassion for it. Just understand what is happening, be intuitive about it, let it make sense, let it settle in, but then take a step back and just breathe. I mean, the panicked phone calls that we get are actually been a lot. I'm kind of concerned for some clients, because that's just not a way to live. It's very unhealthy. So I feel, let us absorb the fear and let us take on the responsibility of watching everything, and let us just do that for you,
And I'll just pair to what Steph just said. And look, we're not trying to tell you that everything is wonderful and we're back and to ignore your portfolio. We're not endorsing that in any way, shape, or form.
No.
However, to wish away that volatility is gone forever. I'm amazed at how many people who, I look at what's going on this year, not the last 6 months. I look at it over the last 18 months. I look at where we were last year, the drawdown in the market, the snapback in some of the very oversold areas. But I look at it as I still think that this market's going to turn out to be in a giant channel. It's going to go back and forth for many, many years. And now I hope I'm wrong. I really, really do hope I'm wrong about this, folks. But I'm getting prepared for that. And I would also just say too, this rally the so-called rally we've been having, if you look underneath the surface, the way Stephanie and I look at the world, I can show you large parts of the overall universe of stocks in the U.S. economy that have done nothing this year. A good case in point, financials. They have stabilized, but they have largely lagged. There's been a handful of AI-related tech stocks that bounced back very strong this year after those big hits they took last year. But again, that's not a normal rally. That's not a broad-based, powerful, new bull market type thing. That's why I'm suspect to it.
But it doesn't mean there's not stocks performing well. Actually,
absolutely.
A lot
There
of
are
our
some.
stocks have done very well this year. The markets, the Dow and the S&P have just kind of been flat this year. The NASDAQ has done well, but it's been driven by the largest names, again, which is pretty common to what's been happening in the last several years. So, your FANG names, right? On the fixed income side, it's actually been the higher yielding, so the triple C names have done very well because they were so depressed last year. Unless the company's having cash flow issues, then those are the only ones that have not bounced back as well. So it's a very disjointed and small piece of each market that's driving the performance. But overall, when a client calls me and says, well, the market's doing well, they're grouping everything. And I said, well, no, about a dozen or two of these companies are doing well, which is pushing the market, but you're looking at one market, not all three of them, Yeah. So you have to really kind of look at everything balanced.
And I think you probably all know that, I have constructed several fairly important market benchmarks that even Morningstar uses in their database. We have one that's actually for common stock called the Winans Legacy Stock Index, which the way we use it, we look at the oldest companies as a continuous sampling of what's going on in the market. That indicator, and by the way, these are all the big names the Apple, the Microsofts, they're all in there as well, but it's non-weighted, meaning I don't favor one company over another. That index for this year is up a whopping 3.6%. So again, this has been a very disjointed rally, and we should I think there's going to be volatility going forward. But a couple other quick things that I just that Stephanie and I did bring up. One, you don't want to turn your back on your portfolio in this world. It's like real estate right now. The real estate experts repeatedly said the real estate game has changed. It has. It's no longer just buy anything and everything and watch it go up. Those days are all clearly over. But the one thing that we did hear was that, that again, there's sections of the market that will probably do well at certain periods of times, and then they'll die off for a while and something else will take off. But again, it's just more paying attention to things and having a discipline to deal with it. We did have I want to jump here real quick. The other part of our conference was about the inevitable consolidation of TD and Schwab.
Yep.
Many of you are going to start getting very thick packets in the mail. My 96-year-old dad called me last night and said, Kenny, I got this massive packet in the mail from Schwab. I don't have time to read this thing. Okay, I said, Dad, I want you to calm down. I said, I want you to call Amy and Mindy and we will walk you through what's in that packet. A lot of it is legalese, folks. So listen, I know many of you have a tendency to say, we trust Ken and Stephanie. I'm just gonna put it into my Winans pile. Please don't do that. But I would encourage you to open it up, take a look at it. But it is your accounts are gonna become Schwab accounts as of Labor Day this year. So this is not down the road, this is now happening. And our Schwab rep made it very clear that they're committed to maintaining their client service. Schwab's always said they've had one of the best client servicing satisfaction ratings in the industry. They're committed to maintaining that. And they also were very complimentary to our company. And in fact, recently we just discovered that we're being added to Schwab's sub-advisory platform of money managers, which is a great honor for us. We appreciate that. But again, we will help you get through this transition. We have a lot of back office work we have to do here. It brings up my point. I want you all to be thinking about this. Your third quarter report that you get from us will be the first time that we've had that report generated with the Schwab conversion. Please keep in mind there might be some mistakes. We might have to send out revision of our reports based on account numbers and other things. So again, there's going to be a lot of balls in the air over this next 60 to 90 days that you need to be aware of.
And we'll pre-test everything, so the transition should be okay on our end within our systems. But things will happen for sure. It might not even be on our end, it might be on Schwab's end.
Exactly.
So it's more the continuity of the history is the concern that I have. But so we'll be fine. You will receive, again, our Schwab rep made it clear that you start receiving information and alerts and things like that. If you are currently a Schwab client, then don't worry about it. Then this has nothing to do with you. This is really just our TD clients. So, yeah.
Yeah, but just keep in mind, what we don't want to have any of you do is suddenly go on your phone one day to look up your account balances and they say zero. Nothing's happened to your money, okay? It's just, folks, we've had a couple of people call on that, okay, believe it or not. One, we don't have your money. We don't have the authority to get at your money. That's something that it's a safeguard for you. But more important than that, that's just part of the conversion, okay? Mm-hmm. So that's important. The other thing that we just wanted to bring up very quickly, obviously we're still happy to report that Morningstar continues to give our strategies gold-plated rankings and performance rankings there. We're one of the big growth areas of our business. I guess there's nothing better than when a competitor hires you to manage money for them. And many of the wealth managers have come to us. These are wealth managers who do estate planning, financial planning, and they've asked us to manage a big chunk of their portfolio. So that's a growing part of our business. But I think it's just important for you all to know that Stephanie and I are basically here every day. Amy and Mindy, we did have one thing, Brittany has relocated to Los Angeles, but you'll be, because of technology, it's seamless. You'll still be able to get a hold of her whenever you need to.
She's actually in our satellite office down there, which is great. So, because a large conglomerate of our clients are actually down in SoCal. So, if you need a face-to-face with Brittany, she is now down there.
Exactly. Yeah, which brings up a good point. If any of you in Southern California do want to have face-to-face time and Stephanie and I are not around, by all means, Brittany would be more than happy to meet with you and to say hi and to take care of things. Obviously, our Las Vegas presence is continuing to grow. I'm going to be spending more and more time there going into next year myself. But anyway, it was a very good conference. A lot of things. People had a chance we had some great food, great wine. They had a chance to talk with many of our panelists of very different backgrounds. And it was very, very well done, and we very much appreciated it. I think the only thing I was going to bring up, I am going to be working on a couple of new Forbes articles. One of them is going to be on the ABCs of bonds. We're still having conversations with people about things like what is accrued interest, Bond prices do move. They are an investment. They do move day in and day out. But we just want to better discuss how bonds are very different than stocks, and you need to view them very differently. And I think just to reiterate that with people would be wonderful. Last but not least, if you haven't done it yet, let the drums roll. Please look at our new website. We put a lot of time and effort into this. And by the way, there's a login there for you to go to your account portal on Tamarack. So if you get a chance, the email address is still the same, or the web address is still the same, but please go check out our new website. We're very proud of it. It greatly updated everything to really enhance where the company is now. And I think you'll all find it very useful and informative. And Steph, anything else you want to add? Or?
No, well, we're in the midst of earnings season. I know this is a long video, so apologies. It's so far so good, so fingers crossed. You usually get a surprise or two. So, but yeah, earnings season's going well. All your quarterly reports should be out. Any questions, let us know. And we will try to do a video sooner, maybe in the next 3-4 weeks. Yep. And any updates that are required. And I hope everyone's doing well, enjoying your summer, and hopefully having some family time.
Absolutely. And I'm just going to say that, for those of you who know me, you know that in the summertime, it's not unusual for us to have some money sitting on the sideline, but we do plan to commit that very fully going into the fall. And because by that point in time, we'll certainly know which companies that we really like, which ones we don't like. But remember that in the case of stocks, yes, earnings will drive what goes on with those individual stocks. Same can be true, again, said too about bond ratings. If a company suddenly has their rating whacked by Morningstar or Moody's, that can have an effect on that individual bond temporarily. So there's a lot of balls in the air, folks. But again, we'll get through this and we'll move into next year, and hopefully the storm clouds will clear on the interest rate picture.
Yeah, the other thing I'd mention is that we made a poignant decision last quarter that if you had a hefty amount of cash, because we do sit in cash, we view cash as a strategy personally. It can be an asset, and it can help actually mitigate a lot of the risk in a portfolio sometimes. If you are at a heavy amount of cash, we actually put it into money markets. We're not unaware of what's happening in the market. We're not unaware of what money markets are earning right now. And we didn't want clients to sit in 15-20% of cash. So if you had a high percentage, then we actively put you into money markets. Don't be surprised if you see them in there. That's why they're there. They're just temporary holdings for us as we wait to find what we really want to commit to the market, and to really wait to see if this rally takes hold. It really takes hold with confirmation. So yeah.
Exactly. Yeah, unfortunately, it used to be in the old days, the old roll accounts, when you rolled into cash, your cash would be swept into a money market account at a brokerage house. Well, those days are long gone. Now we have to manually do it ourselves. So anyway, folks, I know this video has gone long again.
It's been a while.
Yeah, it has been a while, and we're sorry. Like I said, we've been with the conference and everything. We're very busy, and quarter end. But anyway, we hope you're all doing well and you're happy and enjoying your family time and friend time. And we hope to see you all sometime between now and the end of the year. And we will get back to you as more news comes out about earnings. Okay. Anyway, take care, everybody. Bye-bye.